Welcome, everyone. It is a pleasure to have so many great guests again. I want to thank Long Chen, our fearless leader at the Luohan Academy, for organizing another fascinating and interesting set of people to discuss a rather interesting and to me still mysterious topic. When I think about blockchain and finance, I can't not think about the time when about 6 years ago, a young man I know who started college wanted to buy some fake IDs for himself and a couple of his friends. For those who are not in the United States, that's a long story about alcohol and consumption and college. And the person that they wanted to buy it from only accepted Bitcoin. So said young man bought 2 Bitcoins for about $700. At the end, something didn't go through. He held on to them for a little bit and sold them at a small loss. About 2 years later, he told me in a very disappointing, almost crying voice that if he stuck to those $700 in Bitcoin, they would have been worth $40,000. And I said, that's why I'm a microeconomist and not a finance person. I don't understand finance. Interestingly, it went back down to about 7,000 a year later. In 2020, it was worth about 20,000. And if said young man had kept those, he would have had about $110,000 now. That has always been a mystery that I'm going to be very interested in learning how to solve. I have to say that I became a lot more excited about the technology when I saw its potential application to reputation histories, to contracts, which is a little closer to my own backyard. But then about a week or two ago, I wondered if this whole thing is going to be a joke again when Elon Musk suggested to sell his tweet as a NFT. Is that a non-fungible something? And someone bid 1.1 million. So serious or joke, I know we're going to learn a lot today. With that, I will turn to our first speaker, and that is Cam Harvey. And off to you, Cam. You have about 15 minutes. I'll give you a 2-minute warning and then ask you to wrap up in time. Thank you very much, Cam from Duke, who will talk about DeFi, which I don't know what it is, and the future of finance. And you may be muted, Cam, because I can't hear you.
Thanks, Steve, for the introduction. And it's great to kick this off. We've got some really interesting research papers and discussions, and I'd like to kind of set the scene. And the first thing I'd like to say is, obviously things are different today. Diamond said that any employee at JP Morgan that was found trading Bitcoin would be fired. JP Morgan is trading Bitcoin. So it is a completely different story today. And I think that too much attention is being paid to Bitcoin. So many are familiar with Bitcoin. It's difficult to understand, but there's other stuff going on that's way more relevant for what we do in finance. And this is the world of decentralized finance, or DeFi. And let's see. So basically what I'd like to do in the next 10 minutes is to talk about some of the problems that DeFi solves and some of the risks that exist. So these are 5 problems that DeFi attempts to solve. Inefficiency. It's kind of amazing that in this day and age, it takes 2 days to settle a stock transaction, that we routinely pay 300 basis points for a credit card swipe. And in the world of DeFi, the smart contracts are available to anyone. There's very little organizational overhead because the contracts are reused. And basically, if there's any improvements, it's really easy to improve by forking the protocol. So limited access is the second problem. We know that 1.7 billion people are unbanked. Probably more than that are underbanked. And many entrepreneurs with very good ideas are forced to resort to credit card borrowing because banks are not interested in dealing with them. Savings rates are low and loan rates are too high. So in DeFi, we've got yield farming, we've got flash loans, we've got initial DeFi offerings, and essentially it's just a little more democratic compared to traditional finance. Transparency is important. It's difficult in traditional finance to determine how the health of the bank is doing. We know there's regulators that are involved in that, but with decentralized finance, everything is in the open. And staking is a very important mechanism whereby we can enforce basically good behavior on the part of the participants. Tokenization is transparent ownership, and essentially everybody knows where the tokens are, and people know when they're transacting if the other person actually has the tokens. Centralized control, basically that's the system that we're in right now, where we've got central banks, we've got large financial institutions, and basically it's difficult for the smaller players to actually exercise any control. So this is much different in decentralized finance, where even if it's the case that the admins have control over some parameters, if the community doesn't like it, it's easy to fork the protocol and to basically make it more decentralized. So this is something that is definitely new. And the last thing is the lack of interoperability. So to go from in centralized finance, I need to do a wire transfer to my broker, very slow, very inefficient. And this is definitely not the case in decentralized finance, where even if you use a broker, you don't need to transfer any money there. The broker can literally plug into your own vault or wallet. So there's lots of possibilities here. There's the possibility of basically using one protocol to build upon another. There's the possibility of bundling tokens and trading like ETFs. So let me talk about some of the risks, and these are very important, especially given that this is fairly young in terms of this space. So we're very early on. So number one, a smart contract risk. So given that the code is public, it creates a new attack vector. So usually with hacking, you get into a system that's not transparent damage. But given smart contracts are fully visible, it creates additional opportunities. So there's new businesses that focus on auditing, and those audits are mainly concerned with logic errors, but there's also the possibility of economic exploits. And this is just an amazing exploit from February 3rd, 2021, where it's 161 transactions, some of them quite amazing in terms of the size. So this involves flash loans, where basically somebody with no collateral, zero collateral, took out a loan of $200 million to start this off. And you can do this because with a flash loan, the loan is paid back at the end of the transaction. So 161 different components, and this was a very substantial exploit. Governance risk is an interesting risk that really hadn't been realized until literally a few weeks ago. And that is basically what happened was somebody started to hoard a governance token for TSD, and they got enough of the governance token to change some parameters. They drained the TSD and then basically used Uniswap to translate it into something that they could dump. So this is something that is an ongoing issue. DNS attack is nothing special to decentralized finance, but there have been some DNS attacks where essentially a fake website is set up and you put your information in, and then they exploit that information. And obviously, it's a mistake to give away your private key if anybody asks for it, but some people will do that. So number 4 is oracle risk, and this is a big deal. So oracles are necessary because without an oracle to the outside world, a blockchain is completely self-contained. So you need, for smart contracts, some sort of information. You need a price feed, for example. And this is a significant problem as to how to do this. Do you do it in a centralized way? Do you do it in a decentralized way? There's many companies that are working on this. There's front-running issues. Probably the leading protocol right now is Chainlink. Number 5 is scaling risk. So Ethereum right now is 15 transactions per second. Visa can do up to 75,000. So most of the DeFi protocols, if they're not there already, are basically using a proof of work or proof of stake. Ethereum is currently a proof of work, which limits its transactions per second. There are many things going on to improve the number of transactions per second that can be done. So Ethereum 2 is a proof of stake sort of consensus mechanism. It will also implement a sharding mechanism. There's many firms working on layer 2 solutions where some business is done off-chain. And actually one of the more promising ideas is the optimistic rollup, which is basically an off-chain aggregation of transactions that employs a staking mechanism. So I think that the scaling issue is a temporary issue, but it is a significant issue right now, especially given the size of the gas fees in Ethereum. Decentralized exchange risk. Basically, you're trading with an algorithm, with an automated market maker. And there's a liquidity pool, but there are issues in terms of illiquidity and slippage, impermanent loss on the people that fund the liquidity pool. And importantly for us in finance, the price discovery is happening outside of the DEX. So the DEX is just an algorithm, doesn't matter if you're buying or selling, but the discovery is happening outside. So I'm wondering what the world looks like in the future if these DEXs become more and more prominent. How will price discovery actually happen? The number 7 is custodial risk. So this is something that people worry about today. Many institutions didn't want to deal with cryptos because they had no idea how to custody their private keys. And I'm sure you saw this story in the New York Times where somebody's got 220 million Bitcoins locked in a vault, and they've forgotten the password, and they get 10 tries, and then the hardware is destroyed, and they've tried 8. And 2 more tries, or that 220 million in Bitcoin's gone. And finally, regulatory risk. And it's very difficult for the regulators. They know that too much regulation, the innovation is driven offshore. Too little, then consumers get exploited. So it's really a challenge for the regulator to invest the time to understand the technology. And then even if they do that, even if they invest the time to understand the technology, after a year, that knowledge is stale. So you have to continually keep up with this. And certainly this is the price I've paid in teaching over the last 7 years, a blockchain course. And it's also difficult for the regulators to recruit a talent that is knowledgeable in the space because they've got other options. So in conclusion, and to kind of start things off, I would argue that we've essentially been living in the same kind of technological world in terms of finance for the last 100 years. With commercial banks, central banks, stock exchanges, brokers, insurance, the business model is very, very similar over the past 100 years. But I see something different. I see the scaffolding of a new city that essentially reinvents finance. And it is, in my opinion, just a matter of time. Indeed, I was invited to give a talk to the senior management of an unnamed major world stock exchange group. And they also brought in their board of directors. And I said, sounds great. What's the topic? And the topic was, how long do we have? So I think that they understand what's happening. And it is very dramatic. And I think it offers a lot of opportunities. So I do have a book on decentralized finance, and it kind of starts off with this idea that we've come full circle, that the earliest method of exchange was peer-to-peer, the barter system. And in the future, I believe that we'll actually circle back, that everything will be tokenized, whether physical or digital, and essentially we'll be able to do something akin to efficient barter. So that's pretty dramatic in terms of what might happen in the future. It is a great time to be a finance researcher, because there's just so many opportunities here in terms of reinventing the way that we do finance. So I will leave it at that and stop the share.
Thank you so much, Cam. I must say, 14 minutes, 56 seconds with technical difficulties. You are a true champion of time. Thank you for that. I really enjoyed the closing note on that full circle. So without further ado, it's my pleasure to invite Rafael Auer from BIS to put his slides up, and he will be talking about permission ledgers and the governance of money. Rafael, are you there?
Yeah, thank you very much for the kind words, and thanks to Long, Jinguo, Marcus, and Bank for the kind invitation. And especially, I also want to thank Harvey for this kind of nice introduction. Right, he talked about a couple of things, and I think one that was very important is that there are a lot of risks in DeFi that we see now in permission systems, and two, that we are sort of, some observers say that we might go full circle in the sense that you know, we've started with barter, we've had different forms of accounting through history, and now we seem to be having yet another form, and that's actually very much the starting notion of this paper with Cyril and Hyun, and titled "Permission Decentralized Ledgers and the Governance of Money." As always, I need to say that I'm always speaking on my own behalf and not on that of the Bank for International Settlements. And the starting notion of that paper is really that, you know, money is society's memory of economic interactions. Any market is. To know how much you can consume, you just need to remind yourself of not of your employment and consumption history, you just need to look at your bank account. And because it's a record-keeping device, advances in information and communication technology have continuously transformed its form, from stone wheels to coins to banknotes to the rise of centralized accounting, and now maybe today to a point where centralized accounting could become decentralized accounting. And so, right, we know that such decentralized accounting already exists in practice for over a decade in Bitcoin and related cryptocurrencies. Proof of work-based systems have worked for some time, but they also, you know, have a couple of drawbacks. They come, you know, at a horrendous economic cost and a substantial CO2 footprint. They do not prove certain finality, and smaller cryptocurrencies already have been attacked. There are a couple of other issues: scale, lack of privacy, and because of these, actually, when you look at industry efforts, that includes a variety of settings, and certainly also central bank digital currencies at the moment, industry efforts move to permissioned blockchains. Here, rather than an anonymous network of miners, it's a predetermined and known set of validators that augments the ledger, or the copies of the ledger. So insofar as these validators are known and form an exclusive set, this is sort of a system that's in the middle between what we know as centralized finance and what we sort of what we know from cryptocurrencies. And in this paper, what we really do is we want to examine the economic potential of the permissioned variant of distributed ledger technology. And the precise question that we want to answer is, who will guard the guardians in such a system? So the validators may be known, but they may have their own objectives, and nothing can prevent them from abusing their privilege. Specifically, in a permission context, validators need to have incentives to do their job, i.e. they need to run a node, keep a copy of the ledger, and verify transactions, and ensure that only valid transactions and no invalid transactions ever enter the ledgers. And we need for these systems to sort of work on their own without external enforcement, which would sort of take away any potential benefits. It is incentives that need to ensure that the validators actually put in the effort to do all these steps, and that they never sort of accept bribes and undo transactions via the equivalent of a double spend attack. So we study these questions and ask whether from an economic perspective, it would actually ever make sense to set up a market in a decentralized way, as opposed to with a centralized intermediary. And along the way, we also study the optimal design of such market. What would be the optimal supermajority rule? What would be the optimal number of validators? And what would be the fee structure? So the economy we have in mind is a simple credit economy with discrete time and a discount factor beta. Each period has 2 production stages, and in each stage, a good can be produced. There are 3 types of agents. There are those that can produce the early good. And then there are 2 classes of agents that pose as if they could produce the late good. A measure of 1 minus f actually can indeed produce the late good, but a measure of f is faulty and cannot produce. In this market, late and early producers meet, and importantly, without the help of an intermediary, the early producer cannot tell whether he's facing an actual late producer or a faulty one. So there is an information problem here. In this economy, if there was a way to force everyone to behave optimally, faulty producers would simply leave the market, and other matches would work out as follows. In the first stage, A produces at some cost and sends the early good to B, who consumes it. There is a net gain in this, as the cost of production is lower than the utility gain from consuming it. In the second stage, then B sort of repays her debt and produces for Y. Here we assume it's linear, could be a surplus to 2. That doesn't really matter for the model. What is important here is that there are gains from trade, but there is a commitment problem. And this brings me back to the title of my presentation today. To solve this commitment problem, we need sort of a collective form of memory, a record-keeping device. This is where the ledger comes in. It records past behaviors, actions, and outcomes. To the user, the ledger is not known, but the validators can read it at some cost. So this is the interpretation of running a node in such a setup. And they can also update the ledger with new transactions. An important ingredient to the model, because validators are known, and if they misbehave as a validator, they can also be kicked out as a late producer, so as a user of this system. And that sort of has the advantage that it's easier to incentivize the avoidance of double spends attack in this system. Now, what is the exact game played by the validators? They observe all actions and write an honest account of what happened into the ledger. There is a cost of CV to verify the labels of A and B, and there is a privately known cost to communicate the validator's vote to the ledger. We allow for this cost to be stochastic, reflecting the fact that, in reality, there might be communication outages or other operational issues that sort of introduce some noise into what it takes to be a validator. And we're going to consider the class of consensus mechanisms that are based on some supermajority voting rule, where an update of the ledger is considered valid if a fraction larger than tau approves of an entry. And we're going to derive that tau later, the optimal tau later, but we'll take it as given for a moment. Oops. So if in this economy validators do their job correctly, the game now proceeds as follows. All validators, have an up-to-date copy of the ledger. They read the labels of A and B. They actually do this verification cost, and they send their vote that this is the case to the ledger. A then produces for X. We go to the second stage. A produces for B. B repays. The validators again record, yes, everything has played according to plan, and they update the ledger accordingly. The labels of all of B is still a good one. So in the next stage, B can still be part of this market. So, however, again, we've not solved the underlying friction, which is why should validators actually behave according to this this rule book? And one constraint is that agents could bribe validators. So, and another one is that they could aim to free ride on the efforts for others and vote without actually running a full node or verifying themselves. So let me look at these in turn, starting with the free riding problem. Free riding could mean that validators fail to detect that B is actually a faulty producer because they don't actually monitor what's going on. Importantly, this is a coordination game here, as validators can only be punished based on deviations from the majority of other votes, because that's the only information sort of the system has. And if validators assume that all other validators will shirk, then they will not put any effort in themselves, because it's not informative if the others are producing noise. So this is then a game in which higher order beliefs matter. Beliefs not only about what others will do, but about what others perceive that I will believe, and so forth. For game theorists and those working on stochastic outcomes in the presence of complementarity actions, it's a well-known problem, and it can be solved in a global game approach setting, which is what we do. So all validators here follow a switching strategy where they will work for sure if their cost is below a certain threshold, and a well-known equilibrium property is then, even for an arbitrary small amount of noise, a unique equilibrium can arise. So and let's solve for this cutoff by looking at a decision of a validator. The validator at the cutoff will be indifferent between shirking or not if the expected net payoff from these two courses of action is indifferent, meaning the payoff of shirking is 0, whereas working first entails paying a cost, for sure, to find out the label. Then only in a fraction of 1 minus f, the label is actually good, so the game continues. And if that is the case, the validator will communicate the communication cost CS, and you only get the reward if other validators also validate. Here, due to the a global game structure and the assumed uniform distribution of the idiosyncratic communication costs, this is actually a linear function of the, it's linear in tau in the supermajority rule. So the crucial insight here is that when it comes to the design of the supermajority voting rule, a voting rule that is close to 1, i.e. unanimity, makes it very costly to put in one's own effort, because one perceives it very unlikely that the supermajority is reached. And that's why you want to go for a supermajority rule that is substantially below 1. And this is one side of sort of the coin. To solve the free rider problem here, you need to have a low supermajority voting rule. But there is another problem here, which is the bribing, and the bribing problem is that everybody, all the validators do their job and read the ledger. Production in the first stage happened, but in the second stage, instead of sort of paying back with the production of the late good, B instead bribes the validators so that they just write an incorrect history into the ledger. And nothing can stop them from doing that except a mechanism design. So the solution is obviously that validators need to receive rents in order to incentivize correct behavior, because cheating has a chance of being detected, and it thus gives the system sort of a punishment lever, which is if cheating is detected, the validators will be kicked out, they will not receive their future rents, and they will also be kicked out as producers. And this actually makes the reaching sort of incentivizing the validators easier. So I'm running out of time. Let me just give you a summary of the results that we find in this setup. So first and foremost, we do find that there may be a case for such decentralization. The fundamental case for decentralization is simple. Honest record keeping is made easier if those who actively participate in the system as a user also or occasionally are in charge of updating it. But such decentralization does not come for free, as it requires that the many validators be coordinated. And we show that the validators play a public good contribution game, and we derive the optimal voting rule. And for the degree of efficiency of these systems, the degree to which agents are forward-looking matters a great deal. If the system the more the future matters, the easier it is to incentivize truthful record keeping. So that's trivial. But a surprising result is in terms of the comparative statics. We find that the case for decentralization for many validators instead of only one, or sort of in our continuous interpretation, a measure of zero, the case for decentralization is the stronger the more difficult it is to sustain honest behavior. So the intuition harks back to the basic insight, the fundamental case for decentralization. Precisely in instances in which a central intermediary is tempted to cheat, a decentralized setup that features many who want to also stay in that system as a user, they fear being kicked out as a user and thus withstand temptation to cheat as a validator. And that is sort of one of the main results. Further results are regarding sort of the design of the supermajority, how you pay fees, and what the optimal number of validators is, conditional on how forward-looking validators are. I stop here.
Thank you very much, Rafael. Again, I commend you. You're just under 15 minutes. This is a first for me where I don't have to bug people to stay on time, which means, Hannah, you are now going to be under pressure to keep the trend. It's my pleasure to introduce Hannah Haliburda, who I've known for quite a few years, and I am so impressed by her ability to quickly add to her expertise in two-sided markets, expertise in this new technology as she continues to teach us new and interesting ideas. So Hannah will be talking about the race between permission and permissionless blockchain. Please take it away, Hannah. You have 15 minutes.
Thank you, Steve, for the kind words of introduction, and thank you, Rafael, for great setup and introduction to permission blockchains. Because there is, like Cam said, there's so much talk about Bitcoin and about permissionless blockchains, and there are those other elements of the technology that are not so well understood and not so much talked about. So, permissionless blockchain, as exemplified by Bitcoin, has been hailed as this distributed ledger without trusted third party. And like Rafael mentioned, it comes at a high cost: electricity cost, the cost of maintaining the ledger, and the environmental costs, like all sorts of costs that we can think of. A lot of it's expensive to maintain. So when permission blockchain kind of came along, it was hailed either as the best of both worlds, because we can get the distributed ledger without so much cost, or as a flows of both words. So the other side was saying, well, you actually don't really get so much, you don't really get the full decentralization. You still need some trusted party or trusted parties, but because you created a distributed system, you have redundancy in the system, and it's much more costly than the decentralized system was. So you can look at permission blockchain from both sides. And in fact, both views are correct depending on the angle that you are taking. So one thing to remember is that distributed system is not the same as the centralized system. I'm not going to talk much about it, but basically distributed is the architecture of the system and decentralization is the level of control. So you can have both of those views at the same being true at the same time. And what I'm going to emphasize, and I keep emphasizing every time I talk about it, is that when we're talking about blockchains and we're comparing blockchains or thinking about whether blockchains are worthwhile, we need to be really, really clear. Why do we seek decentralization? What benefits do we expect from this distributed system? Why do we want a distributed system? And only if we're really clear what is the objective, we can start to model it. So there are many different reasons why we may want decentralized system and distributed system. So for example, if we want a censorship-resistant interaction where we have anonymity, it's a different objective than if we want efficient information sharing or information aggregation, like when we are thinking about oracles. The one aspect that I'm going to focus on today is the transaction safety. And I think that this is the most important aspect from the financial applications. So transaction safety is preventing, replacing, or erasing a transaction from a ledger. And like Raphael already mentioned, is that participants in a system, being a centralized system when it's run by one party, or distributed system where it's run by multiple participants, each participant has their own incentives. And we are economists, so we assume that everybody is just maximizing their utility. They are opportunistic in a way. So a good system is going to prevent misbehavior, prevent attacking by making attacking costly. What I want to emphasize in this presentation is that permissioned and permissionless blockchain fundamentally differ in how they make attacking costly. And this has an effect on what is happening in the equilibrium, or the cost in the equilibrium. Okay? So in a permissionless blockchain, because nobody can limit the permission, there is no identity requirement. And therefore, the participants are unknown outside of the blockchain, and there can be no accountability outside of the blockchain after a transaction is happening. Therefore, the cost of preventing an attack needs to be borne up front. And then if everything goes well, this cost is recuperated. So in Bitcoin and in proof of work permissionless blockchains, we see this cost of preventing attack as the cost of mining. So the only reason for the mining to be costly is to prevent attacks. Because if mining is costly for regular miners, for honest miners, it is going to be costly for the attacker. If mining is cheap for the miners, then it's going to be cheap for the attackers. So the mining has nothing to do with the cost of validation of transaction. The only reason for mining to be costly is to create safety of the ledger. And then the miners are rewarded with the mining reward to compensate them for the costly mining. In permission blockchains, however, we have known parties validating the transactions, and because their identity are known, they are accountable outside of the blockchain as well, or they may be accountable outside of the blockchain. And therefore, we can have an ex post punishment in case an attack has happened. So what Raphael was saying in his presentation, in the environment that Raphael and his co-authors are studying, the punishment is exclusion from the system in the future. But there may be other punishments possible. So what does it mean for the cost of the two systems on the equilibrium path? Because in permission system, the cost of attack is borne only if attack happens. Then sufficient prevention of the attack, the fear of the punishment if attack happens, is actually not happening on the equilibrium path. So if the system is well designed and attack is not happening, then this cost is never paid on the equilibrium path. Whereas for permissionless system, this cost of preventing attacks has to be paid every period. It's to be paid and recuperated, but it's not simply a counting method. It actually needs to be paid. So for the proof of work systems, it needs to be the electricity spent and the work being done to mine. It needs to be lost in order to be credible, and then it may be recuperated by the mining reward. In proof of stakes that are now held as this environment saving mechanisms, you still need to lock in your stake. You're not getting any opportunity benefits. You cannot use this capital elsewhere. So you need to pay for creating this safe environment and preventing attacks. And you may be recuperated with the new stake if everything goes well. So because in permission blockchains, if on the equilibrium path, if attack is not happening, the cost of preventing attack is not paid, then permission system can bear imposing higher cost of attack up to a credible threat of punishment. And therefore it can keep larger size of transactions safe than permissionless system. I'm not saying that it always does, but it will be up to design that I will be talking about next. But there is this. This is where this feasibility is coming from. Okay, so in permissionless system, the safety really comes from the price of the native cryptocurrency. So due to, and this is actually, I'm going to kind of go more quickly because this is a point that has been made many times in the literature by now. But due to the free entry for miners, the total cost of mining per block, the total cost of the system of mining a block is equal to the total reward, which is the block reward or the mining reward from a given block, which includes also fees, and the price of the cryptocurrency. So, for Bitcoin right now, this is about $300,000 per block, and block is every 10 minutes, right? So if an attacker wants to attack and rewrite the ledger, they need to redo this mining. So it is possible to attack with less mining power than the rest of the system, less than 51%. But if the attacker has the same amount of computational power as the honest blockchain, then it is pretty sure that it can successfully attack. So if an attack needs W blocks of the length, then and per block the cost of the attack is given by this formula, then we can define the total cost of attack. So let's say that it takes 10 blocks to successfully attack Bitcoin's blockchain. Right now, this C would be about 3 million to attack Bitcoin blockchain. So now, if the benefit of attacking the blockchain is larger than the cost of attack, then those transactions that offer larger benefit of attack may be vulnerable. And this is assuming that after the attack is discovered, and if the attack is discovered, then the price of the crypto goes to zero, and the attacker is not realizing any gains from the block reward. Then this, if otherwise we're going to, as I'm going to claim in a moment, actually, even if the attack is discovered, the price doesn't go all the way to zero. It is actually even cheaper for the attacker to attack. But what is the main point of this slide here is that the transaction safety and permissionless system is directly related to the price of crypto, and this is not something that designers of the system can design. This is not depending on anyone. It's only up to the market. So Bitcoin is quite safe right now because it's really high price. But if the price would drop right now to $100, actually the vulnerability would be substantial, especially with a lot of idle computational power that would be going offline with dropping of the price. And as it was earlier mentioned, I think by Cam, is that definitely by Raphael, is that smaller coins already have experienced double spend attacks. So the protocol itself does not guarantee immutability of the ledger. Ethereum Classic and Bitcoin Gold have experienced double spend attacks, and there are also some other double spend attacks that are claimed not to have been discovered. And what we have seen is that price dropped, but did not go to zero. So this is the level of safety of permissionless blockchain depends on this price, and the price is not really depending on the design of the blockchain. So this is a little bit different for permission blockchains. There we have a number of known validators and accountable validators, and not all validators need to be involved in validating each transaction. There may be a subset of them, and Raphael in his paper has a formula to derive it. But whatever is the subset of validators involved in validating a particular transaction, we're requiring some majority of them to agree to put this transaction in the ledger. And now, what is the N for a given transaction, and what is the majority is actually a part of the blockchain design. And we may think of it as something that we decide, but there is a larger aspect of this blockchain design. So there may be technological limitations. So it may come from how we define what consensus we are going to choose, how nodes are able to communicate, how many exchanges they need to exchange, how reliable is the voting mechanism that they are using. So there are a lot of the blockchain design aspects. But what I want to emphasize are the two dimensions of control in blockchain design, which are especially important for permissioned blockchains. So one dimension of control is control of validators. So how many validators do we have for a particular transaction, and what is their relative power? Because in permissionless blockchains, all validators are equal unless they have more power. But in permission blockchains, they may be hierarchical, and it may be positive or negative thing for transactional safety. Overall, this control of validation of a transaction is going to tell us how many nodes do we need, how many validators do we need to conduct a successful attack. The other aspect, the other dimension of control is control over validators. So who is permitted to become a validator? And then what are their incentives at accountability? So in a way, what is the punishment? Are we allowed to kick them out? Because there may be a design where once you give a permission, you cannot revoke it. If you can revoke it, can you also levy some additional punishment? So is it just exclusion or some monetary punishment as well? And
I'm giving you a 2-minute warning.
Okay, depending on where on what is the setup there, the setup is going to tell us how much the validators can be punished. So those are two elements that can be designed in a permissioned, at least to some extent, in a permissioned system. So why does it matter? Is first of all, as the attacks are going to involve any nodes, and this may be different for whether we want to replace transaction or whether we want to ignore transaction, this N is going to be related to the design choice. And it is going to tell us how many nodes will need to cooperate to attack, and how many nodes will need to be bribed. And something that may be interesting in permission blockchains that does not show up in permissionless blockchain is if we put too high majority rule, like 80% of nodes need to agree on a transaction, then we need to bribe only 20% of the nodes to ignore a transaction, and that may also be a valuable attack. And this is something that does not come up in permissionless blockchain. So, like I said, attacking nodes can be punished, which to a value PI, which follows from the blockchain design. And the punishment may be executed with probability tau. And this is because the punishment is executed outside of the blockchain, or may not be executed. So if we are going to just simplify and say that everybody can be punished to the same punishment, the transaction safety is given by this formula. What is important is if you believe that the nodes will never be punished for their misbehavior, then your only option is to go for permissionless blockchain. But if you think that there is a chance that there will be even not one, but there is a chance that they will be punished, then you can design a permission system with that may be better with high enough NNP. So I'm not talking here, which is a separate, very important topic about the cost of having larger number of validators. But if you can levy an infinite P, then you are better off with a centralized system, which of course is we cannot levy infinite fee. And this is why having distributed system may be better for transactional safety than centralized system here. Okay. So I have talked about how the two systems are different.
So
and
Hannah, I need you to try to wrap up.
I will try to wrap up. I just have two remarks really. So one is that the two systems can coexist at the same time. But the permissionless system is going to be inherently more costly. But there may be a reason why we may prefer a permissionless system. Right, and it may also be for different uses. The second point that I want to make is interconnectivity. If we have those two systems existing, can they connect to each other? And we cannot really mix the consensus mechanisms, but they can interconnect with each other via asset transfers. And there is a really interesting concept how you are going to move Bitcoin to Ethereum, and the same way you can move it to permission system. And via oracles. So the information from one blockchain can be an input for execution of some transaction in the other blockchain. And also what we are seeing right now is that we can have a very much permissioned DApps running on permissionless blockchain. And what we can kind of look forward to is we can have permission platforms that would run peer-to-peer, maybe permissionless smart contracts. So those concepts can be mixed together, not only coexisting, but they can interact with each other as well. So let me stop here. Thank you very much.
Thank you very much, Hannah. And we now move to our penultimate speaker of session one, Jinguo He from the University of Chicago, who will talk to us about slashing enforcement and the limits of smart contracts. Jinguo, you have 15 minutes.
Thank you. Thanks. I don't think I needed 15 minutes, but it's great to be part of this team to talk about the related issues. What Cam was talking about, Raphael and Hannah, is pretty much on the same issue, where I would like to point out one thing that as a contract theorist, immediately get down to it. And I think that I'm still keeping up with the progress of the technology, so that try to reflect on the economics behind it. So I was, long time biggest supporter for proof of stake, although that a computer scientist seems to tell me a lot of glitches of the technology side of how does make the proof of stake fair. These type of questions, which is a fascinating discussion with them. But for economists, I feel like this is just such a great idea. You have a slashing penalty as an important part of incentive provision to prevent a wrongdoing. Validators, they're going to put their deposits there. It's just the real, so something there, so that if you did something wrong, then it gets slashed or gets penalized for protocol misbehavior or rewarded for being good citizens. So carrots and sticks, that's everything we learn as economists. So it gets implemented by smart contracts. And, whenever we think about smart contracts as economists, we will say, oh, okay, you have an input, then you have something, and then, if you did something wrong, then you get penalized, right? It's great. So indeed, that you see that in the practice, you check this is Ethereum 2.0. It has been implemented on people do gets penalized. You see that? And that's great. Okay. Wait a second, is something that always in my mind. You chatted with Hannah, also many other people. It's just who manages these smart contracts. I mean, in a way that we're in a decentralized world, then once you recognize this, then this is not obvious. Okay, I just want to tell you that there's a limit, and I do think this is important. So who executes the reward or penalty? Okay. So cannot be a centralized machine which acts on agents' behaviors, which typically we think about the contracts. Think about the typical, mechanism design or contracts is like, people have their actions, whatever. I'm gonna have a slides to tell you what the economists are thinking later on. But think about it, it's like a behaviors, right? You penalize behavior. But here is the quotes from consensus. This is the detail, okay? So that's why it's called enforcement. In all these cases, which is wrongdoings, the offender needs to be caught in order for the slashing process to be triggered. Okay, the whistleblowing validator will create and propagate a specific message containing the offense for Prosper to include it in a block. Okay, so using some layman language, basically, that if you did something wrong, that there's some whistleblower need to catch you, and then he or she needs to put it there and tell everybody that this guy did something wrong. And then there's some proposal needs to put on the proposed transaction. My understanding, I think that I'm using the analogy of a Bitcoin here or Ethereum. The tip, it's very similar. And then you need somebody to get some vote, or people just follow the block, so that if that block that saying, pointing out or whistleblowing block to be a part of a consensus, then you can execute on it, then you get penalized. Okay, then you have all these questions of how do we know votes are disciplined, follow up, and then the votes over votes, that kind of question. So I do think, so here is something that I check online and get these slash, oh, by the way, this is a joint with Justin Lee that we're a team and always discussing these type of issues, which is fun. These are the slash the validators, slash the buy. Okay, so that's great. You create must be the creating incentive for these guys to come in, which is true. So I'm not talking about incentive of the policeman here, but in practice, in this system design, you do have that. And also that Cam was talking about, there are some companies actually are created, right, to do this type of thing. With that just means that the whole mechanism seems to work. Okay. All I'm trying to tell you is that it's not just, I checked with some practitioners in China, in Europe. They thought that probably as long as you have a smart contract, then you always can prevent, can punish wrongdoing. That is really not true. What you could act on is something called a decentralized consensus, which means that you have to get something that everybody agreed, and that's to me that is a very deep points that the contract theorists need to recognize. Okay, so here's what I want to say. From a computer scientist perspective, it's a piece of code that basically input-output. There's nothing fancy. And the same code runs on every node on our project. Okay. From an economist perspective, I'm going to ask the question, Bent is here. Is the input variable, which is here bad behavior, contractible? Contractible means that it's something that everybody will agree on, and then in the real world, it's the court. this is especially tricky because smart contract runs on a centralized machine. This is the typical way of the smart contract will run on a central machine. That's the typical economist perspective before doing the Bitcoin blockchain, that type of thing. So I want to emphasize that the contractibility is a equivalent objects. It's smaller than the observable, even smaller than the locally recorded, let's say votes. So I'm going to have one slide to talk about the HANA where related topic on the voting, permission chain. That's the next step. So take back basically that using a language that are probably on the circle of blockchain people, basically that the smart contract only acts on or execute on the on-chain data as opposed to the off-chain data. So that's to me that's a very important part, that whenever you design a system, like later on outside of the payment system, think about the trade finance, which I think it's a big part of the blockchain in the future, is that you need to think about whenever you want to penalize, there's something is on chain, the evidence, or you can think about those. So here's one slide that is just telling you that for this whole logic is really coming from that I'm studying these voting-based consensus protocols. So Byzantine fault tolerance protocols. These are fascinating topics that I unfortunately at this point that I don't think economists has a handle on that. It's just because they're very, very complicated. The computer science using their own algorithm language, which is they are doing fantastic job. There's somewhere that we need to work on to put it together. So in that framework, it's basically a leader, first proposer, block, and then group of backup nodes, then votes. Okay, and hopefully that whatever the block, if the block is good, then everybody votes, and then several rounds of voting to make sure that all the nodes in this system actually recorded the same thing. So then they involve this honest nodes and some Byzantine nodes to make sure that the system is in good standing. What you need to have is more than 2/3 of the honest nodes, that type of thing. So then you kind of like thinking, okay, this sounds like economics, sounds like economic modeling. Basically, you're voting, and in the end, if we have some smart contracts to penalize these malicious nodes, then things are good. I think that it's a little bit, we need to do a little bit more, just because, and at least I'm explaining to you what I thought, is that I thought that it should be easy to do because of votes. Then once you have a smart contract, if you have a bad votes, which means that, you see something bad, white, but you say it's black, well, you can penalize that. That's not true, okay? What you need to, as I explained, that if the votes itself is just you say it, not recognized by everybody yet, then the smart contract cannot act on it, okay? So what I'm trying to tell you is that can you reward or penalize bad voting behaviors directly? Not necessarily. That what you could reward or penalize is that if people vote and then later on in the next round, that the people see that your voting is really sucks. And then they might, saying that, look, you are this identity ABC and your voting seems to be inconsistent with a lot of other things, or you do double spending. And then I'm going to single you out and say that, okay, you are the bad guy, and therefore that we're going to penalize you. Okay, so this is just telling you that in terms of the mechanism design on the blockchain, you need to take that into account. So a little bit of the notation, but I'm going to take maybe at least at most 1 minute. So in the traditional principal agent model, so this is for those economists. So agent takes a action A, ideally would like to offer a pi A, but often the time we will say, these things, you cannot see it. So it's a noisy version of the A gets realized or gets contractable, and you pay. You just pay, get the pi. Pi is the payment, right? In a decentralized blockchain context, we are working on it, but it's just that it depends on the applications. But conceptually, it's basically a group of nodes take a set of actions A, and only A plan it can become consensus as a result that the contractor can act on it. And that A plan really depends on the applications. For instance, in the what Cam was talking about, if you do have a lot of companies that gets good incentives that try to caught every misbehavior, then in equilibrium it will be quite good. But you have to ask that, okay, what makes these companies are so actively working on these issues? And I want to emphasize this issue is about centralization versus decentralization. It's not about permission versus the permissionless. Just because that even if you have a permissioned, you still need a set of nodes to have these consensuses so that you can act on it. There's a separate issue which is interesting from a contracting perspective. So Ben is here. I just want to tell you that what you see there, right? It's not necessarily bad behavior. It's just the equilibrium that people get slashed, but there are some issues that actually it's because of the glitch. So here's a 75 Ether2 validator gets slashed this week due to a stake bug. And then at that time, so what happened was that this stake is a kind of a pool. It's like, a proof of stake pool, so that there are validators to work for that pool. And because of that pool has some bug, then these validators as a worker actually later on gets reimbursed by the pool. That's itself is a very interesting from the perspective. Okay, this is my last slides, and I will just so in a way you can think about it that blockchain provides a very good technology, I think, to manage the world, to manage the a business, a finance. We are excited. I am excited about the technology itself. From the very, very basic perspective, I think that it still does not escape the core issue of anything that is behind the way that a society is working. So it resemble laws, the legislation, you can just code it on the smart contract. But if you think that the smart contracts can resolve everything, that's not true. Just because that whatever it gets implemented on the smart contract, the core idea that you need to making sure that every node to get executed. As a result, that it's look like a judicial question, which is something that worth everybody who wants to design the blockchain needs to think about. I'm done. Thank you.
Thank you very much. As you predicted, under 15 minutes, you're at 14:35. So thank you, Jinguo. I am going to do a little shift because in session 2, we invited 3 people to offer their thoughts on these topics, Wei Zhang, Marcus Brunemeyer, and Will Kong. And Wei Zhang, unfortunately, has to teach in about 12 minutes. So I am going to take the decision that I'm going to push Long's last presentation in session 1 out by about 5-6 minutes. And I would invite Wei to join in and share some thoughts for about 5 minutes, if that's okay with you, Wei.
Well, thanks, Steve. So sorry for the trouble. So I just have to teach. I think I will be very brief. I just want to, share some thought about this. I thought the 4 discussions, further speakers have given excellent, insight about a lot of things that's happening in this domain. So these are a wonderful development. And as Cam, there's a lot of exciting things going to happen in finance. I want to use this opportunity just to say a few words about this. Anna motivated, right? So why should we do the centralization? I think for the topic centralization versus non-centralization, the clear issue, we first need to figure out what's the problem we want to address from here, right? So I want to sort of, say a few words about my understanding about conflicts between platforms and the user. In many ways, sort of, I think this is a key motivation for decentralization. I think Cam mentioned a lot of things, but I think sort of the reason why Bitcoin generated so much excitement across the world. Of course, a lot of it's about the illegal transaction, but at the same time, sort of Cam also mentioned sort of how can you trust central banker for not to issue too many currencies and not to create too much inflation. The distrust about someone else is really sort of a key, excitement around. In fact, actually, this is common. A lot of tokens had been issued in last few years, thousands of them. In the way, sort of this is meant to address an important issue, right? Centralized platform have owners and equity holders with control and cash flow rights. This sort of give them powerful incentives to develop the platforms like Google, Facebook, we all use every day. But at the same time, the powerful incentive can also create a sort of undesirable problem like pre-commitment and not abuse users, right? So in fact, actually, lots of abuses had been creating concerns around. So in fact, I've been working on this in the paper with Michael Sorkin, trying to understand sort of what motivates sort of the wide use of cryptocurrencies. Tokenization can be viewed as an effort to resolve conflicts between platforms and the users, right? So as I mentioned, this is sort of the original excitement about Bitcoin. Crypto technology makes it possible to delegate controls to a set of pre-coded algorithms. Platform developers get paid by issuance tokens rather than traditional equity, right? Trustless through decentralization makes it possible for a tokenized platform to pre-commit. We analyzed a simple, plan utility token to show that indeed, sort of doing so can accomplish sort of this kind of goal for pre-commitment without worrying about a lot of this implementation of the consensus protocol, right? But at the same time, utility tokens also give less incentive to subsidize user participation and to further development platform. So this, in some sense, there's a trade-off, right? So if you want to get rid of centralization, sort of come with some benefit. The benefit is the powerful incentive to develop, right? But if you get rid of it, you might get the downside. The downside is that there's no incentive to do other things as well. Of course, sort of a lot of discussion, Rafael and Hannah, Jinguo, all discusses about the tricky issue about implementation of a consensus protocol, right? In fact, actually, any implementation may well lead to new conflict between users and the record keepers or validators. So basically, you have to introduce new stakeholders into the game, right? So, with the proof of work, miners may have incentive to strategic attack or to fork the blockchain. Cam also mentioned about this kind of risk. So there might be conjecture issues. And proof of stake can improve on many of these dimensions, but at the same time, create new problems. Jinguo mentioned. Right. So essentially, sort of given control and cash flow right, record keeper may reintroduce the commitment, but in a new form. Right. So and in Cam's paper, which I read, sort of you can have a new different design of tokens, security tokens or equity tokens may provide more incentives for development of the platforms. But the strong incentive may also reintroduce someone to amass tokens. Right, so this is the governance risk. Someone may have the powerful incentive once sort of the tokens gives us very strong rewards. So someone will have incentive to amass token and eventually seize control, right? So this will recreating centralization and thus the commitment problem. So I think sort of this is sort of ultimately an important issue we have to address for DeFi to eventually happen, right? So I think the blockchain and the crypto technology have substantially expanded the organization space. So this is a powerful tool. But between the conflict between centralization versus decentralization, it seems like we're doing circle, right? Full decentralization removes incentive, but if we put the incentive back in, incentive will induce abuses, right? So in some sense, there's a very difficult dilemma one has to address in this, right? So here, just a bit of conjecture. Rather than the full, the wholesale removal of equity holders, perhaps blockchain can help prevent the specific or limit specific abuses of users. So that would be very clear. So what's the problem we want to address, and then how to do it, and then we can talk about the optimal design. So at the moment, it's too overwhelming in some sense. All right. So that's all I want to say. Thanks, Steve, for flexible on time.
Of course, thank you very much, Wei. And when Wei mentioned that he has to run to class, I had this flashback of the first time I visited All Souls College in Oxford, where I learned that there exists a college with no students. And I thought, wow, that is so awesome. Anyway, with that, thank you, Wei. And now we are going to Long, the last of our session 1 speakers. Long, you have 15 minutes. Please take it away. And Long will talk about centralized finance, decentralized finance. Now I know how to say those acronyms, and the future of finance.
Thanks, Steve. It's my good pleasure to share my thoughts today. And the future of finance, of course, is a big phrase, and we know that scholars want to be precise and focused, but I think sometimes it's worthwhile to brainstorm on some of the big picture issues. I would like to start with Tim Harvey's conclusion in his report, in his very interesting paper. So despite the fact that Ken gave a lot of warnings, but I think he's quite enthusiastic, as you can hear from him. And he said that ultimately we see DeFi as the greatest opportunity in the coming decade, and looking forward to the reinvent of the finance as we know it. Now, that enthusiasm reminds me of that in the past several years, I went to United States and London a lot to talk to many colleagues. And I found that when we talk about fintech, we talk about different things. In China, fintech has happened a lot, but without pretty much the arrival of the blockchain. But in the Western world, we pay a lot of the hope on the blockchain, and of course, it's making a lot of progress. So I think, and that's one of the purpose of we gathering together to talk about what's happening in the future, because maybe put together, we can think a little bit different, but that's the more complete picture of what's going on. Now, because we're talking about the future of finance, perhaps we can start by talk a little bit about what are the major functions and challenges of finance. Now, we know that one of the major challenge of the task of finance is to allocate resources using financing and investment. And another one is to, through the resource allocation, is to incentivize people's activities. And that's always been there, but somehow I think we have paid much more attention to it, especially since we observe how DeFi is taking off. Now, but if we think about what's the common challenge for these tasks to be done, I think it's the lack of asymmetric information, or lack of information, especially the lack of trustworthy information. So that's one problem. And the second problem is that I think Ken somehow mentioned is that it's the inefficient use of the information. Sometimes information, firstly, we don't have enough information. Second, even if we do have it, it's trapped in some institutions. And each time when we have to do risk assessment, we have to do it repeatedly again and again. So the result, the consequence is that most of the resources, the capacities, and our activities cannot be measured and in a trustworthy and efficient way, and therefore it's hard to price them, to transfer them, and to trade them. And so the end result is that the finance ultimately thus far have two big problems. One is that it's not very inclusive. Secondly, it doesn't really serve the real economy very well. Now, so my first big picture point, I'm trying to put all those, the different digital technology that is transforming finance. But my big picture point here is that actually a lot can be done by just reducing the cost of acquiring and processing information. So when we think about the digital technology, we obviously have besides blockchain, we have a lot of other things. We have the connectivity through the mobile internet and IoT. We have big data, and we have the artificial intelligence, we have cloud computing, and then we have blockchain technology. But without blockchain technology, we can go very far. And I'm trying to give you some examples of what we experience in China. So China is quickly transforming itself into a somewhat digitized economy, and without materializing the impact of blockchain yet. And so the picture here, what shows is that China's e-commerce as a percentage of the retailing, and it has taken off. Back in 2010, it was actually lagging from many countries, but actually in the past 10 years or so, China's retail sales now, by the end of last year, was about 27% of the retailing. So, and if you look at the mobile payment, so now so back in 2011, China's mobile payment amount is about 15 billion, and the United States about 8.3 billion, so very similar. But now China is like the 100 times of that United States. So my point here is that without the blockchain yet, China has somehow transformed itself into a mobile style living country with a lot of applications in finance without the much benefit of the blockchain yet. Let me give you a couple of examples. One is the lending. So I'm going to use the case of my bank. In the past several years, my bank has provided lending to more than 20 million SMEs. Half of the entrepreneurs of those are women. And they provide this so-called 310 model. It takes 3 minutes to apply, 1 second to get the funding across, and with zero personnel interference. And so, and that is also working with more than 100 banks to do that. So works with financial institutions. So, and that gives Ben Holmstrom gave the famous claim that information is the new collateral. So that's on the one example. Another example is with something we call a credit pay. So essentially, for the young people in China, 3 out of 4 do not have credit cards. But in the past several years, Ant Group has been able to provide credit pay to, it's like a credit, but it happens with a payment. And it has served more than 500 million users in China. I'm giving you a couple of pictures to see what's going on here. You can see that during the COVID crisis, before the COVID, and you can see that on the left panel, you can see that it's for people, consumers using the blue bar is the ones they using the credit pay, and the red bar is the one without. But you can see that the ones without are hurt most. On the right panel, you can see are the merchants. They are the supply side. As you can see, also is the ones that do not use the credit pay, they hurt most. So this will really happen. My point here is that credit pay helps both the consumers and the suppliers, especially a lot of the SME service providers. So that's my first point, is that without the decentralization, without much of the blockchain, if you have the big data, you have the connectivity, you can actually already help the finance a lot, make it so much more inclusive. China has transformed into a country with more than 1 billion mobile payment users without much of the use of blockchain. Now, then, of course, we would like to have the blockchain. Blockchain can solve the problem. I think to make the information, if you have it, it becomes much more trustworthy, and so it can be transferred. So you don't want this to be trapped into one institution. So I think there are a couple of ways to do this. One way is to use the DeFi to get around the institutions. And another way is to use the permission chain. That is to they have the multiple institutions, but somehow they trust the agreed upon the quality of the information. So so the first part, let me brief mentioning of the DeFi part. Now, despite a lot of the concerns some of the experts already mentioned today, I think the DeFi, it starts with the cryptocurrencies, has made tremendous progress. And just some examples, you can see that many of the financial institutions that are handling the crypto assets, they have huge valuations. For example, Coinbase, its valuation has grown from 5 billion to 100 billion. And you have the PayPal, you started to use the Bitcoin, and Robinhood increased from 11 billion to 40 billion within half a year. Now, and so a DeFi world indeed has made a lot of progress. So as back in 2008, we have the Bitcoin, then 2011, we have the Ethereum as the smart contract platform. On top of that, we already have the stable coin that is to make the currency more stable, and we have the deposit and the lending of the tokens. We have the automated market makers. We also have started to anchor the real world asset into the tokens to enter the DeFi world. We also have enabled the real world information to pass into the smart contracts. So a lot of progress have been made in the DeFi world. And especially, I think what's most interesting is how they use the tokens to incentivize all stakeholders. Indeed, the whole DeFi world grown by financing itself. So I think it's really, we can see how a lot of the progress has been made. But there, of course, it has a lot of limitation of the DeFi world. I think the one major problem is the trilemma, beautifully explained by Marcus Brilliant-Mayer and in his papers. Basically, if you want to get around the current institutions, the cost of proving everything is so high. So it's very hard to be efficient. And so it's not only the scalability issue, also that you have to, I call this the Oracle problem. But so basically, it's actually, there's a lot of because the real world is based on the institutions. So if you want to get around a lot of things, then basically you are very far from the real world. So you, in a sense that you are not serving the real world very well yet. You are kind of far from it. So that's a huge problem of the DeFi, besides its compliance issues. But I think the DeFi, as I said, it already made huge progress, especially with the digitized assets. As we know, for this beautiful, I'm not sure how beautiful it is, the picture, but we can see that it's also already worth like $69 million. So I think the combination of the DeFi and the digitized based asset is likely to take off. But still, there's a huge real economy that there's very little trustworthy information that can be put into the DeFi world. So that is a huge problem if you want to be as inclusive as Cam Harvey has hoped. So that brings us back to the progress of the permissioned blockchain. Now that I want to introduce to some experience from the on-chain, which is the permission chain powered by Arm Group. So it has something to claim that is now being on-chain has been used for in more than 50 use cases. More than 1 million companies are connected using on-chain. It has more than 100 million items to be uploaded onto the on-chain, and it has the #1 accumulation of the patents of the blockchain in the world. And now, and I don't have time, but basically it tries to provide the basic the infrastructure for the permission blockchain. It has the the basic technology. On top of that, it has the smart contract platform. Then it can support finance, support other daily life use cases, and also the for public services. Now, let me give you several examples. One example is that it can use products tracing on the e-commerce platforms to make sure they are trustworthy, and so that has increased the sales by a lot. And so actually hundreds of thousands of items on the Alibaba's e-commerce platform, the categories of products, they're on chain, and their reputation, the negative review rates actually decreased by 50%. So somehow they are more trustworthy. And another good example is the jurisdiction chain. Now, out of the about 3,800 jurisdiction courts in China, about 3,200 of them now actually can use the evidence from blockchain from jurisdiction chain yet already. Now another example.
Just giving you a 2-minute warning.
Okay, I think almost that's good. So then another thing is the electronic signature. It's not Ant Group, but it's one of the student I have in China. So what it does is that this just give you several numbers. Some of the so all the documents will be digitized, and now it's only about several percent, but they're really progressing very fast. And as my student predicts, he's an entrepreneur, that within 3-5 years, I think he think about half of the contracts, all the contracts will be digitized. And as you can see, they can be used to be in the courts. Of course, they can be used to support financing because they represent the, and also based on the smart contracts that can be settled quickly. And finally, another interesting example is selling the movie tickets, and now it used the tokens, and it found that largely increased the power because the fans are able to they can promote this to their friends, this or that. So you can see that the power, as we see in the Western world, in the DeFi world, then you can see that the marketing power from 1 yuan to 3. 1 yuan spending of the marketing that leads to from 3 yuan to 5 yuan. But anyway, so let me conclude. My point here is that I see different type of digital technology, and they are all shaping the future of finance. It's happening right now. So my belief is that DeFi will integrate better with the digital world and make a lot of progress, as we already know. It will also be accepted by more institutions. Those institutions can issue tokens and digital assets and enter into the DeFi world. So as a lot of the participation, I think that's exciting. But still, whatever they do is if they want to serve the real economy well, the real economy needs to be the trustworthy information needs to be digitized, and that probably has to be through the permissioned blockchain, and that will also help the finance a lot, and that trustworthy information can work with either DeFi world or the transformed financial institutions, including those exchanges and the funds, the ones that who ask the Cam Harvey that how long can we survive? I think they are trying to making the change too. So in the end, then I believe that the digital technology, including blockchain, are transforming finance at least in 3 ways. One way is the much better connectivity, collecting and processing information and that can lead to financial inclusion. It's already happening a lot, tremendously in some countries like China and other places too. And then we have the DeFi and the digitized world. And then we have the finance based on permission chain, which actually is connect much closer to the real economy. So I don't think the 3 groups, they conflict with each other, and I don't think they replace each other. But together they are making finance much more inclusive, accessible, and affordable. And the key is to have all the resources, capacity, and activities measurable in an efficient and trustworthy way. The goal is to improve the two goals we talked about in the beginning. That's to improve asset allocation and to motivate economic activities. And so I think that's the joint force in some way. So let me summarize. I'm going to summarize by slightly rephrase what Cam Harvey started. I think that's great, but I want to refer to a little bit from my point of view. That is, finance is an information-based activity, and digital technology is the revolution of information. So ultimately, we believe digital technology will be the greatest opportunity of the coming force to the reinvention of finance as we know. Thank you.
Thank you very much, Long. That concludes our first session. We are running late, but we already squeezed in Wei Zhong, who had to run to teach. So now I am going to pass the baton over to Marcus Brunemeyer, also from Princeton. Marcus, I don't know if you want to pop up some slides or if you're just going to chat. The floor is yours, and you have about 5 minutes. You're muted, Marcus.
Thanks, Steve. Now I think you can hear me. It's a pleasure to be part of this group and to be part of this conference and learning from you all. And I would just want to give a few thoughts. I will use some background slides, not sharing anything particularly. Cam outlined very nicely what the risks are in decentralized finance and what one probably has to work on to mitigate these risks. But then Raphael and Hannah and I put everything nicely in the blockchain technology and what are the different trade-offs between permissioned and permissionless and the validators aspects. And I would like to put this a little bit in the framework I was thinking with Joseph Abadi about that in this blockchain trilemma language. And of course, Long already mentioned it before. So, but I think this essentially you would like to have three aspects: the resource efficiency. You don't want to waste all this electricity. You would like to have some no rent extraction. If you have a centralized or a permissioned blockchain, there's some group of people who can extract some rents. And you would like to have self-sufficiency, so you don't want to rely too much on outside trust. So, and the question is, which way, what do you want to give up on? What can be shown essentially is that you cannot have all of these three. You have to have some compromises. You have to give up one of the three. So, for example, if you go for a proof of stake blockchain arrangement, you take on some outside trust, so it's not fully self-sufficient. The record-keeping blockchain, or you can give up, if you go for a Bitcoin permissionless blockchain, you give up essentially the resource efficiency, and then you're actually along this dimension. You can still move along this axis here, pick a point, or you can actually say, okay, we don't want to have a centralized or permission blockchain where a group of people can extract some rents, but then you go for, you give up this no rent extractions, you go for centralized ledger. So you can be anywhere. Here you can also be in the middle somewhere and have more complicated schemes. And I think that's a guiding principle helped me a lot to think about this through. And I think it came up very nicely also, probably more nicely as I presented here in Hannah's presentation and also in Raphael's presentation, how things can be fit together in this setting. But if you want to give up, let's say, the self-sufficiency in particular, and you go for some proof of stake or some other arrangement where you rely on some outside trust, then the question is, what is this outside trust? Is it, how is the outside trust organized? And is there some capacity to punish? And that's, I think, where Jinguo's presentation came in very nicely, where you think there's this various ways to punish from outside. And then the question is a little bit, how is this outside trust organized? Is it a centralized trust? So we have a centralized nodes among all these guys, or we have some scaling local trust where, different players are connected with each other, but there's no centralized node. And that, so the outside trust organizing structure, how we can punish each other. And that's what Jinguo was talking about, the carrots and the stick. how this is designed, I think is very, very important. So it might vary a lot, and I think I would like to see a little bit more work and discussion perhaps later on. When is what arrangement the best? So when can we rely on some certain outside trust? And what is the institutional arrangement for particular record-keeping problems? Which institutional arrangement fits? And we can rely on this type of outside trust or that type of outside trust, and the carrots and the sticks will be applied accordingly. So that's, I think, what I wanted to say, putting in a slightly different language about the presentations, and then go a little bit more to the platform, to the finance, and also to the interoperability issues across platforms. I think that's one of the big issues as well. In particular, if you think about tokens, and there's a lot of, we have talked a lot about tokens. You know, what's a token in the first place and compared to an account-based system? And how do we want to have various platforms interacting with each other? And you know, that's where the interoperability comes in. And of course, each individual platform has no incentive to really make it very interoperable, and that you can actually pass on the token from one platform to another platform and create some competition across the platforms and some standards, essentially. And there are two types of interoperability. One is a technological interoperability, that you can actually just move the information you have collected in this one particular platform to another platform. And then there's can you transfer simply the tokens? What's the exchange fee? Must be an exchange rate from this particular token to another token. What's the fee on that? And of course, platforms themselves have an incentive to make this not very interoperable. And they'll probably have some fees, you know, if you want to convert, you know, some dollars or some other tokens into this platform, it might be negative because they want to lure you in. But then once you have these tokens, they might make it hard to get out of this token. So it's a little bit like a Hotel California arrangement. And then you can also, the platform itself is conducting monetary policy on its token and can inflate it away. And that's, you know, some work I have with Jonathan Payne, trying to understand how monetary policy works on this platform. And this platform has more power. First of all, it might be a profit maximizing incentive rather than a social good providing entity like a central bank. And it might also, you know, try to interact with other platform design issues where you have increasing returns to scale from a platform economics perspective. So if there's platform economics perspective, we have to think about, and then there's the finance and currency economic perspective where you do monetary policy on your tokens or token monetary policy interacted with platform design issues. And I think that's what we have to think about, how to combine this. That's what I do in this work with Jonathan Payne, which gives you a richer environment and standard monetary policy, because you also would like to exploit some natural monopoly tendencies in platforms and so forth. So that's, I think, the interoperability issue, I think, is a big issue, making it essentially platforms compete with each other, and how to combine.
Just giving you a 1 minute signal, Marcus, to try to wrap up.
So let me just leave it then at that. I have another slide which would talk a little bit. The one is this token, a separate currency. Just to think about this, should we have a segmentation of all the different currencies, that you have many, many different currencies floating around rather than one more unified form of money? Is this an issue as well we have to think about? Of course, it goes way beyond whether it's designed as a blockchain or it's designed as a permissionless or permission blockchain, or what the initial designs are. But these are all interesting issues to focus on in a broader picture, including, you know, all the different aspects of decentralized finance, or DeFi, Cam was starting out with. So let me leave it at this and pass the buck back to Stephen. Thanks again for giving me this opportunity.
Thank you very much, Marcus. And I have to say, I am in awe of your skills with Zoom and the presentation. So our last invited speaker will be Will Kong, who also has about 5 minutes to offer his discussion thoughts on what we heard today. Will, please take it away.
Thank you very much for having me here. You know, the topics of blockchain and DeFi are something really dear to my heart, something I've been thinking about for the past few years. We've seen the panelists offering great perspectives and insights on quite a number of issues covering many fronts. I wasn't sure if I need to use slides, but I did jot down notes as I listen in. And so I'm just going to share the 2 quick slides that I have after listening to what our panelists have discussed. So what I'll start with is, I think we got a reasonable idea of what the current status of blockchain applications and DeFi is. In terms of blockchain as a decentralized ledger, we're seeing it being applied to supply chain, smart contracting. On the finance side, it's more about cryptocurrencies. Thus far, we've seen applications in both permission and permissionless. But if we zoom in on the kind of a decentralized finance front or finance applications, there are really 2 areas that have received wide adoption. One is just payments of stable coins, right? Think about Tether, Bitcoin, MakerDAO. The other front is kind of lending. Some people use the word yield farm. People are staking, lending to earn some interest and rewards. MakerDAO also has this saving rates reward. There are other websites such as Compound or Terra Luna. It's very much related to staking that I'll touch on in a little bit. But in other areas, we start to see some applications having reached wide adoption. It's not so much about financial inclusion yet. Decentralized exchange is one example. Derivatives, I think they are still more technically oriented, kind of blockchain savvy people working on these fronts. But for stablecoin, for payments and lending, everyday folks can use the technology. So if we synthesize what the speakers have talked about, I would like to go back to something that I've emphasized in my joint paper with Jinguo and also book chapter with Long about what makes blockchain special. What can they potentially solve? Right. One issue is single points of failure, be it technical, right, computational failure and all that, storage failure, or economic incentive driven frauds, cybersecurity attacks. And as Hannah has pointed out, there is a trade-off, and it's not free to get this benefit to avoid single points of failure, because proof of work requires electricity. It could damage the environment. Staking is also costly in terms of the alternative use of the tokens. So that's almost an irreducible trade-off there, right? We want to do more duplication. Well, it's going to consume some resources. So that's fine. That's something we can accept and handle. The other aspect is concentration of market power, right? Remember, all these decentralized blockchain systems were originally advocated as disintermediation. It's not so much about disintermediation, it's about reducing market power, right? Think about proof of work. Because the lack of dynamic long-term market power that enables us to use certain dynamic incentives, Raphael's work has touched on that as well, because other people are going to decide how much I get going forward, so I better do my job today, right? All these issues would correspond to what Cam has said as well in terms of centralized control, limited access, or inefficiency issues. But there's a third benefit of using blockchain, which is about the information interaction, the coordination role that Long has touched upon as well. So taking a step back, what is blockchain? It's a ledger. It's something that enables us to exchange information, to trace assets, transactions, to allow information to interact, rather than being siloed or kept asymmetric across agents. That's something enabling us to achieve interoperability, to deal with opacity, issues that Cam has touched upon as well. In terms of design flexibility, it is quite flexible. We can make things anonymous or not. We can make it auditable from one side, but not from the other side. Computer scientists have been actively working on secure multi-party computation, zero knowledge proof, snarks, bulletproof. all types of startups, Oasis, Zcash, Duality Lab. There's quite a number of them. And in this earlier studies, my co-authors and I have also looked at accounting, auditing, and how permission blockchain leveraging on these information interaction functionalities as an infrastructure can solve certain problems and improve efficiency. So what do I take away from all this? Well, firstly, Jinguo also mentioned it's important to think about the incentives and punishment, right? So an important way of providing
just giving you a 1-minute warning. Well,
incentive within DeFi or general blockchain system is to provide rewards when you stake your tokens, and slashing is the opposite, right? You get punished. Examples using slashing, staking, compound. There's a number of other projects. So I think that's something we need to explore further, to think about how tokens are hybrids of currencies and commodities and investable assets. Hao Xiang and my co-author Ketang, they have this commodities as collateral paper, and token as well. Token are being used as collaterals in many cases. So here I list one preliminary project I have with Zhiheng He and Ketang, documenting crypto carry trades, premium to that, and also how reward ratio, staking ratio, and token prices all interact. I think that's something we can learn a bit more. We can learn more or study more about oracles, Internet of Things, or artificial intelligence in combination with Internet of Things. That's something Long touched on as well. Mobile internet, IoT, because that's where we get information fit in. That's something enable the contractability that Jinguo was talking about. If we come to contracting part of it.
Will, I need you to wrap up.
Sounds good. And what else? Mechanism design. Raphael talked about CBDC design, but in general, we don't worry too much about centralized versus decentralized. We worry about, as consumers, we care about a functional system, whether centralized or decentralized, whoever designs it. So incentive provision, information disclosure, all these are important design parameters we need to think about. I don't have time to touch on the last point, which is tokenization and tokenomics. I do have these slides. Basically, I do want to just emphasize that SEC's categorization of tokens is really not very fine, in the sense that it's not only about securities versus utilities. It's really the general payment token that, related to monetary policy, Marcus has worked on that, platform tokens that's tied to the functionality of particular
Will,
platform.
I need to be the bad guy and tell you to wrap up.
10 seconds.
10 seconds and counting.
Yes. And also product ownership token that includes non-fungible tokens. The auction at Christie's art house is an example. And finally, regular cash flow based tokens that's related to Hovey tax and so on.
Okay, thank you very much, Will. And we are now going to go to the open discussion that is quite a bit shorter than we hoped at the beginning. And this is always where everybody gets a chance to share some thoughts. I know I have a little signal from Cam that you would like to comment on Wei Xiong's paper. And since I'm going to pass over the mic to you, there's one thing I would like you to comment on, if I may. Being very much a novice, here in San Francisco, where I live, there are self-driving cars experimenting all over the streets. That's a very different type of technology with very different objectives. And of course, there's a question of regulation there. And many people talk about how, that first time that a self-driving car is going to veer off the side and hit a mom with a little carriage and baby in it and kill them, that's likely going to be the end or many years delay for anything in this technology. I wonder if you could say a word or two about the potential, pushback of regulators if something goes wrong with these kind of technologies. But please Go ahead, Cam. I know you wanted to make some other comments. And after Cam, if anybody wishes to raise their hand, and we'll have a discussion for about another 22 minutes, and then Bengt Holmstrom will take us to a close.
Thanks, Steve. And let me just answer your question first, if I can answer it. And that is that these problems have already happened. So this is a continuous process where there's failures, there's hacks, people lose their money, and we learn. The difference between kind of centralized finance and decentralized finance is with decentralized finance, it's anti-fragile. So if there is a problem, then you can essentially fork very quickly, and the code is open source. You fix it and you redeploy very quickly. So the pace of improvement is really dramatic. So I've got to actually head to the school for teaching also. So I will just make a few remarks. This was a great discussion, but let me mention just a few things that struck me. First, I have no problem with some blockchain applications being permissioned. It totally depends upon the level of trust that you actually need. So for Walmart doing its food chain, that's like an internal supply chain thing that doesn't need like a public blockchain technology like Ethereum or Bitcoin. It would be ridiculous to do that. So to go to Hyperledger Fabric or something like that, that makes a lot of sense to me. So this discussion of the different trade-offs, the blockchain application depends upon the business application. Do we need trust or no trust? So, so I think that's a really good discussion. However, when it comes to finance, and I see things like AntChain, where they, on the slide, they're #1 in filing patents, that just totally goes against this kind of movement of decentralized finance, where everything is open source. And the idea is that if you've got a better idea, you build upon what somebody else has actually done. So I'm reminded, last week I had in my course, the co-founder of Coinbase and also the co-founder of Paradigm, the same person. And he said something very powerful to my students. He said that the current wave of fintech, and he mentioned Stripe, he mentioned different fintech startups. He said it was like putting lipstick on a pig. Okay, so, and basically what he means, these technologies that, yeah, they're great right now. They build upon the centralized finance backbone. They save consumers a lot of money right now. They're definitely better, but they're fleeting, and beware. So I think that that's really important. The last thing that I will say is let's be careful here in terms of proof of stake. Proof of stake is a very general concept. Proof of work is much more focused. It depends upon mining algorithms and hashes and stuff like that. But proof of stake is a very general concept. Yes, it is true. What Wei said, that you could get concentration as a result. So the rich get richer, but there's different ways to implement this. So it might be that you want to implement this with the people that use the platform rather than the people that are just hoarding some coin. So there's a lot of work to be done here. It's very exciting area, very early. And again, this was a great discussion, and thank you for inviting me.
Thank you very much, Cam, both for your early presentation and for your thoughtful comments. So the floor is open for discussion, questions, comments. I know we lost a few folks. I know a bunch of people had to go teach, but we still have a good number, about close to 60 people here. I'm sure some people must have some comments. And of course, any of the presenters, if they wish to add something, then I know, for example, that Hannah and Will, I cut both of you short. So Hannah, if you want to add some thoughts in relation to what you presented, or maybe some of the follow-ups we heard, then please take the mic. And in the meanwhile, anyone else, please raise your hand if you wish to offer any questions or comments. Hannah.
Thank you. Thank you. Yeah. So, I mean, what I was talking about was the, as I laid out the differences between the permission and permissionless blockchain, I was talking about the coexistence and interoperability. And I fully agree with Cam that the coexistence is partially driven by the fact that they have different applications, and they may, like, for example, if we want censorship resistant interaction, then permission blockchain is actually not going to get as far. So there are some things that only permissionless can do, and there are some like, if we want safety, if we want cut the efficiency of the operations, that permissionless is going to do. Permission is going to do much better. But even for the same applications, we may have coexistence of permission and permissionless systems. And like Cam said, it may depend on the trust, but it may be not only the trust in the environment, but it may be the perception of trust by the users. So we may have the financial transactions being done on Bitcoin in parallel to the financial transaction being done in permission blockchains, but different users may choose to use different avenues, because it will be more expensive to do it on a permissionless blockchain. So you need to really have a conviction to pay for it. So this is why I think that they will keep coexisting. Not one is going to drive out the other, but there may be some general advantages to one rather than the other. And then if they will coexist, they can connect to each other, even though they will never be connected by the consensus mechanism, but they can exchange information. And like we have, so for example, what we have in DeFi right now is that we can put Bitcoin into Ethereum blockchain. And of course, not directly, because those are different blockchains, but you can have a custodian service that is going to take your Bitcoin and issue so-called wrapped Bitcoin on Ethereum. And then you can use it as collateral, for example, and exchange it for Ether. So this type of interoperability can be used between permission and permissionless blockchains when you can move assets in between. And also you can use the information from one blockchain to another. So information from a permission blockchain about supply chain may be used for trading or for some collateral on DeFi. For loans, for example. So there is, I think, a great, possibilities, realm of possibilities of how they can both coexist and interact with another. And also, what I was saying is that we can build permissioned applications on top of permissionless blockchains. So we already have that. We tend to think that DApps and DeFi are all decentralized. What DApp means is that it runs on Ethereum. The app itself, whether financial or not, does not need to be decentralized. It can be very much run by a centralized party, by an owner of the contract, and it can limit permissions to access that contract. So we already have that. And then, we can build a permission platforms that more efficiently run permissionless smart contracts in the future. So those were my kind of final thoughts on that.
Thank you, Hannah. We have a couple of questions that popped up here. I'll mention both of them so that if folks feel they have the knowledge or at least some educated, informed thoughts, I'd love to hear them. So one by a question coming from Hue Wu is, what will governments what are government views of decentralized finance? And Xingxia Zhang asks, will DeFi be a kind of foam? I have no idea what that means, I will admit with no shame. And will it be broken? So I'm curious if anyone wants to offer some thoughts on current government views on DeFi. And I will be very curious to be enlightened about what foam is. Raphael, you look like you're eager to say something. Oh, I can't hear you. I don't know if it's your mic because it doesn't show that you're mute.
No, it's better. So I think, governments around the world are quite welcoming of DeFi. Could even, in some jurisdictions, I even think it's a bit of a hype because, desperately want to get that industry. But one branch of government that has universal concerns are law enforcement agencies, right? Because it's very hard to enforce AML, anti-money laundering, and counter the financing of terrorism laws in these systems. And so to me, I think governments always take a time to respond. And to me, the big question is then, if you have efficiency gains in DeFi, can you still have it once it's properly regulated? And the answer is probably no, because then it wouldn't be DeFi anymore. So where do we go? And it's very hard to say, right? Because if you think back just 10 years, we put in a lot of regulation targeted towards very large banks, and that led to the rise of non-bank financial intermediation. So you never know what's going to happen. But I think what we'll definitely see is that all the this toolbox of apps, smart contracts that is now being developed in the DeFi space is going to find its way one way or another in regulated finance, and we're going to think about new regulatory envelopes for DeFi. I've proposed one that's called embedded supervision, where you you take the advantage that the data is public out there to check whether some regulatory measures are met, and hope that the whole system is more efficient than a centralized one. But we don't know that yet, right? I think it's not true that all the places are not all parts are in place yet, and we'll have to see. And that's, I think, why regulators around the world are very open at this point, and then they'll come up with regulation over time.
Thank you, Raphael. Will, I see you have your hand up. And in the meantime, let me throw another question that has been on the top of my mind, if anyone wants to attempt to answer it, and maybe it will just show my ignorance. So, I started with that little truth but humor about the price of Bitcoin over the last 6 years. And I know there's Ethereum and other cryptocurrencies. And I'm just wondering about volatility in these currencies, because what if tomorrow someone comes up with another cryptocurrency and everyone says, oh no, that's really the one, and suddenly Bitcoin plummets? And I'm just curious if people have any thoughts on whether this could be a chain of one coming after the other. But Will, please go ahead, and then if anyone wants to comment on my question, I'll be happy to hear that. Will.
Actually, I want to speak to your question. I've been thinking about that as well. There are various sources of volatility, but so far, and for sure, stablecoin is a holy grail in the industry space. For Bitcoin, it may not be going away immediately, even if there's a way more stable currency, because Bitcoin is not really serving as a medium of exchange at the moment because of the finality time, because of delays and other issues, capacity, processing capacity, so on and so forth. So to me, it's more of a, people have used the word digital gold. It's a equilibrium coordination. Due to legacy, people know it. And if we want something rare, we know Bitcoin is in limited supply. There could be other things in limited supply. Just there are other metals in limited supply, but we don't value them as much as gold. So I think, for a while, as a store of value, coordinated store of value, it might still be around. And to the questions asked earlier, I was at a conference yesterday, blockchain conference, And the Congressman Bill Foster was talking about government's view of DeFi and blockchains. My sense is that the government is going to be really tight on regulation, but if you're touching on financial inclusion, democratization of finance, I think the attitude is indeed open to learning more and exploring more in that space. And also for the foam part, I believe we're talking about bubbles. For the art piece of people and the buyer, the mysterious buyer has been buying art pieces one by one and repackaging them, introducing new NFTs. So we do see the innovation leads to divisibility of ownership, potential repackaging of art pieces for which diversify risk and allow more people have ownership. So there are innovations there, but if you are doing NFT of a tweet, I do think that's a bubble. Just my 2 cents there.
Okay, thank you very much, Will. I see we have a question from Jian Zhang. With Gary Gensler to become SEC chairman soon, do panelists think the US will become a leader in regulating crypto tokens representing digital assets in the real world? I don't know if anyone has any thoughts on that. We have about 5 minutes still for open Q&A. So not a ton of time. And if we're running low, then I'm going to turn it over to Long, because I'd like him to put in a few words, again, in his capacity in this topic, as well as the head of the Luohan Academy. So Hannah, I see your hand is raised. Maybe take a couple of minutes, but no more, and then I'll pass it on to Long before I let Bengt wrap it.
Yeah, so if I may comment on the tokens, right? So there's a lot of talk about NFT and then regulating tokens connecting to real assets. So first of all, when you're buying NFT, whether it's for tweet or for art, you're actually not owning the art, right? You're just buying the NFT, and there's nothing holding you to issue NFT on somebody else's art and another NFT on that art. So so this is why when you are buying a tweet, this is like buying baseball card. If you're buying NFT of a tweet, you're buying a baseball card. You're not buying the player. You're not even buying the photo on the baseball card. You don't have any other rights. And you can buy NFT of anything, and then you can sell it, and there will be people buying it just like they are buying baseball cards for a lot of money, and this is a mystery to me as well. And for the tokens, tokens representing real life assets, the big issue is the connection between the real world and the token, and both to make sure that the digital representation is representing the real world asset, and then the digital representation is not replicated. And issuing of tokens is a different issue than moving tokens on the blockchain. So Bitcoin's blockchain solved the issue of moving tokens on the blockchain. Once we are starting to issue assets from outside onto the blockchain, then we have so-called gateway problem. And this is a well-known issue in not only permission blockchains, and permissionless blockchains as well. So I will leave it at that. Thanks.
Thank you, Hannah. Long, take a couple of minutes and then we'll pass it on to Bengt.
Right, so today, so when we talk about this centralized or decentralized, so a lot is really about how are we viewing the views, the role of the institutions. But I think if we think about what we need to do finance well and serve the world well. So I mentioned a couple of things. One, basically, you need to have the information. And second, you have the efficiency of the information, so that when you have information verified by somebody, then that information can be reused. So I think that, again, come back to, we have to build the trustworthy information in an efficient way. It's not really about do we need institution or not. It's really about how we can make this finance to be more efficient. In that way, then, I don't think we should be too stuck up about the institution versus the decentralized. And also, ultimately, we really want to serve the world. Are we supposed to be too excited about the decentralized finance that really has its own world and has very high valuation, but it doesn't really help a lot of the current economy very well. So we have to balance all those things to put together to think about what's the purpose of finance and how should we perceive it? What should we be excited about? But there's one thing for sure, that is that any institution or not, we have to change the way we do finance to make it more efficient and to make it more, the information trustworthy and spread a lot more. So that will make it better. I will stop here.
Thank you very much, Long. And I will now turn it to our last and final speaker, Bengt Holmström, who will offer his thoughts, and we will wrap up in about 5 to 6 minutes. Thank you, Bengt.
Thank you, Steve. And I have to commend you for your timekeeping. We are exactly on time. Well, this has been a very fascinating dialogue again. It's a great series that Lohan Academy and Long has kept going, and I'm sure we see much more of this. I am an outsider. I don't know that much about blockchain. I've followed it and so on, but I've seen sort of looked at it from various small angles. So I thought I would basically just rely on instead of commenting on blockchain or anything that I said about that, I would like to comment on how a contract theory might be thinking about this, and especially opening up a question that has, I think, Jinguo touched on, that has to do with the link to legal structures, renegotiation, and so on. So before that, I would say the one thing that grabbed me originally was the fact we have a new form of notary service. So it's important to understand on the traditional blockchain, if I have understood it correctly, actually, is that it just records things, just like a notary just signs, it gives a verifies that it was you who signed the paper. Doesn't say that it's valid what's said on the paper. That no testimony to the content of the paper. So I understood the blockchain to have exactly that same property. There's nothing else is really reported that did this happen, and then this is an immutable record of what happened. And so we should keep that in mind. But it's clear that the notary service has been important for hundreds of years, and to have a new way and more safe way of notarizing things and on a scale, I think is just incredibly important. I think there are two questions that have surfaced here or been under the surface, perhaps, but that come to mind to contract theory. Is first of all the scope of DeFi, the scope of contracting on this, the scope of smart contracting. In my view, the smart contracts are very much focused on execution in some sense. That is, it's about, of course, writing a contract, but also sort of monitoring the execution of the contract. And that cuts out the question about how this will affect the institution. And this is what Long, I think, was talking about all the time. There are going to be institutions. We are not going to go back to a peer-to-peer wholesale in any sense of the word, because this whole conversation hasn't mentioned a single time, real world contracts. Let's call them real world contracts. That is, we agree with, me and Steve agrees on it, and then we disagree about the unforeseen contingencies, which is Oliver Hart's big item, and Steve has actually worked on it also a lot. So, if you go and talk to legal experts and the whole legal community, they are not about, arguments about how was this executed correctly. That's a mechanical thing. they are all about how to interpret it in the context of information that has entered. So, so incomplete contracting, that's a mystery to me in some sense. How are these new forms of executionable algorithms going to change the world of, let's call it real world contracting? I think that was the language that Long used. That's a critical thing. About the, if one wonders, let me just illustrate it, that renegotiation, which is another interesting question here. First of all, how do you renegotiate these contracts? We may have made a mistake, or we may have seen new information, want to renegotiate. In my understanding, it's actually possible, because you just write another new contract that sort of disclaims or just replaces the old contract. And I don't want to go into the details of what happens, but I'm pretty convinced, or I can ask people, it's got to be possible. The point is that renegotiation is a very central, valuable element of real-world contract. That's how strongly it's contrasts with this idea of, is the execution correctly done, just as we agreed. Renegotiation, an absolutely central element of efficient economic contracting. And one of the reasons is that, as I said, information is entering, and we have emphasized a lot, or heard emphasis on the hold-up problem. But actually, it's equally important to understand hold-up is essentially the core of capitalism. The whole idea that you can own and hold up somebody else is the center of capitalism. And in that sense, in my mind, this hold-up problem has turned just as much into the question of the value of hold-up in the first instance. So, for instance, if I'm investing in something like a valuable quality, which Steve likes or consumers like, I have to have a hold-up right, that is, prevent people from taking it in order to actually appropriate the investments.
I have to give you a minute warning.
Yes, the hold-up itself is, of course, the reverse problem, where we want the contract to be carried out exactly as we wrote it, so to speak. And that has the virtue, again, that in that case, when is that valuable? That's valuable when I'm making investments in, say not for Steve, but for myself. For instance, I invest in some better production facility or something like that. The transaction is the same, but it's done in a more efficient way with a more efficient technology. So these things are understood. But I want to just close by saying that this whole world of real-world contracting and legal infrastructure and legal involvement in interpreting contracts, what did the parties intend, etc., that lives in a different universe than what we have been talking about today. And I think the future will have very much to do with it's going to have to deal with this question about how does this affect the legal infrastructure. And I'm not criticizing, I'm just saying that that's a fascinating question. How do these two going to go together? Thank you.
Thank you very much, Bengt, for your thoughts and wisdom. Again, I want to thank the Luohan Academy for organizing, I believe, our third such session. We had the first on platform, the first on platforms. We had one on big data and ownership, and we had one on privacy. And this is yet another very exciting and thought-provoking conference, mini conference. I commend Long for being able to put together such an amazing group of experts. Every time I learn new things, I hope that everyone feels the same. And I look forward to the next one, where Long will invite us, I'm sure, to yet another fascinating set of topics. Long, if you want to say something for 20 seconds, no, then we're all good. Thank you, everyone. Thank you, the folks at Luohan Academy, for managing this, and I'll see you next time.
Thank you, Steve.
Thank you.
Thank you.
Thanks, everyone.
Thank you.